Hey everyone, welcome back to Corporate Decoder, the place where we decipher the sometimes strange language of corporate filings. Today we're cracking open Arbor Realty Trust's latest 10K report, their annual report, and honestly, this one's a bit of a roller coaster with numbers that might make your head spin. We will simplify it and make it easier to understand. Let's dive right in. Arbor Realty Trust is a real estate investment trust, or REIT, which means they invest in real estate and aim to pass profits to their shareholders. Think of them as a bank, but specializing in real estate loans for things like apartment buildings. The main thing you should keep in mind is that they make money in two main ways: by lending money and then collecting interest, and also by managing the loans they make. They have two main lines of business. The first is their structured business, where they make more complex loans like bridge loans, which are short-term loans, a lot of times so that a project can get started, and the agency business, where they work with government-backed groups like Fannie Mae and Freddie Mac to offer more standard mortgages. One big strategy is to use their short-term loans from the structured business to bring in more business for their long-term government-backed mortgages or agency business. They're essentially trying to create a pipeline where one type of loan leads to another, growing both sides of their business. So how exactly do they make money in their structured business? They provide different kinds of loans to real estate folks who might not be able to get money from a regular bank. One way they do this is with bridge financing. A borrower might need short-term money to buy a property, fix it up, and then get a more permanent loan later, also known as SFR portfolio financing, or offering loans to those looking to purchase single-family rental homes. Also mezzanine financing, that is loans that are riskier than a regular first mortgage, with an equity kicker as additional profit for them. In the agency business, they're all about those standard government-backed mortgages from Fannie Mae, Freddie Mac, and HUD. These are generally less risky, and Arbor makes money by originating. That means creating, selling, and then managing these mortgages. They also have private label mortgages underwritten to existing agency standards. Looking at the numbers for their structured business at the end of last year, most of their money was in multifamily properties, with a good chunk also in single-family rentals. Their loans usually have a pay rate that can adjust, 6.89% to be exact, and they mature on average in less than a year. Their geographical distribution was heavy in Texas, Florida, and Georgia. As for the agency business, the fees and gains from selling loans were 1.63%, and fees for managing the servicing of loans was 1.15%. Most of their loans were Fannie Mae, followed by Freddie Mac. A lot of these properties are in Texas and New York. So what's the process? It all starts with origination. They have originators all over the country who work with property owners and brokers to get loan applications. These applications then go to underwriters who are like detectives, digging into the details to assess how risky the loan might be. Then there's the credit and investment committee who have to sign off on everything. If a loan is approved, it goes to the service team who send out bills and track payments. Finally, they have asset managers who keep an eye on properties to make sure they're doing well and the loans are safe. Now let's look at the fine print. For their structured business, Arbor mainly borrows money to finance their loans, trying to keep their debt to no more than 80% of their assets. They also use tools like interest rate swaps to manage risk, basically trying to avoid large losses from fluctuating interest rates. They must maintain qualifications and licenses in order to comply with regulations. Otherwise, they risk losing their approved lender status with the GSEs and HUD. There are risks involved with Fannie Mae loans. They're required to share a piece of the pie, and Fannie Mae has the right to take back the license. The company faces a lot of competition. Other REITs, banks, and even government organizations are all fighting for a piece of the pie. If competitors are willing to take on bigger risks or accept lower profits, that could hurt Arbor's business. At the end of last year, Arbor had close to 700 employees. They emphasize training and development. They aim for fair pay, good benefits, and even a flexible work policy. The goal is to keep employees happy and productive. The report also discusses a number of possible risks for Arbor: an economic slowdown, changing interest rates, declining real estate values. Could hurt Arbor's ability to get financing and impact their profits. They are also at risk of loss if borrowers default on loans or if they have to repurchase loans that don't meet certain requirements. If borrowers are struggling and the amount of loans that aren't being paid back on time increase, that could be a big problem, especially with Fannie Mae loans where Arbor shares the risk. If anything goes wrong with their relationships with Fannie Mae, Freddie Mac, or HUD, if they fail to properly manage all that data flowing through their computers, they could have a big negative effect on business. If Arbor can't remain qualified as a REIT, they would get hit with a huge tax bill. And of course, there is always the ever-present risk of a major public health crisis like a pandemic. To stay competitive and keep growing, Arbor needs to be able to attract and retain qualified loan originators who are in touch with local market conditions. The company's agency business could get stuck with liabilities if it breaches any representations. In addition, for a big chunk of the loans they manage, if a borrower doesn't make payments, Arbor is still on the hook to pay the investors, and this could really hurt their cash flow. As it relates to securitization transactions, if investing in the securitized assets weakens and losses are retained due to regulation, that could reduce returns. Also, the laws are always changing, especially for GSE and HUD programs, so Arbor has to stay on its toes to keep up. They may not be able to adequately employ hedging strategies in certain circumstances, instruments can get pretty pricey, and bad things can happen if a counterparty fails, potentially creating contingent liabilities. Lastly, economic and political issues can significantly affect business in ways that are hard to predict. They do realize how serious cybersecurity is, and they do have a cybersecurity team. They hire consultants and technology pros to review security, also ensure its vendors are up to par with their systems, but cyber attacks are constantly evolving. Alright, those were the main points. That was a lot of information, but we needed it to understand the risks involved. So what's my take on Arbor Realty Trust? Well, they're definitely operating in a challenging environment. The rising interest rates is a double-edged sword. It is good for the structured loan portfolio and not so much for their fixed-rate GSE agency business. Based on current short and long-term rates and predictions of the forward yield curve, I believe that there is reason to assume they will be negatively affected by future results of operation. And with that securities class action lawsuit, they are a constant target that could end up with huge costs to settle or defend against a lawsuit. While I think Arbor is doing a decent job managing these risks, the housing market has got a lot of headwinds based on their recent performance and what I expect from them in the future. And comparing the current stock price with other companies, I'd say a reasonable price range for Arbor Realty Trust right now is $11, $14. So I'm leaning bearish at the moment, but their high dividend is hard to overlook. If you found this helpful, hit that subscribe button and let me know what company you would like me to decode next in the comments below. Thanks for watching.